Palantir remains one of the most misunderstood assets in the technology sector. While retail sentiment often swings between spy tech and AI hype, institutional investors view the company through a different lens: the industrialization of data. To evaluate Palantir effectively, you must understand its role as a foundational infrastructure layer, not just a software provider. Section 1. The architecture of decision-making. Palantir operates through three primary platforms. Gotham serves the defense and intelligence sectors, providing the digital nervous system for government operations. Foundry is the enterprise equivalent, allowing complex organizations to integrate disparate data into a single source of truth. Finally, AIP, the artificial intelligence platform, integrates large language models directly into these environments. Crucially, Palantir's revenue model is built on deep integration. This is not plug-and-play software. It is mission-critical infrastructure. This results in exceptionally high switching costs and long-term contract structures that create predictable, recurring cash flows once a customer is fully onboarded. Section 2. The commercial growth engine. Historically, Palantir was seen as a government-heavy contractor. However, the structural shift is now occurring in the commercial sector. Through their AIP bootcamps, Palantir has shortened the sales cycle from months to days. By showing immediate utility rather than selling theoretical futures, they are accelerating customer acquisition. For the private investor, this indicates a transition from a lumpy, government-dependent model to a scalable, high-velocity enterprise software business. Section 3. The ontology moat. Palantir's real moat is not just code, it is the ontology. Most companies have data silos that don't speak to each other. Palantir creates a digital twin of the entire organization, mapping how every asset, person, and decision interacts. Once an organization's logic is built into Palantir's ontology, removing it becomes an operational risk. This sticky nature is what drives long-term shareholder value and high lifetime value per customer. Section 4. The sober risk framework. No institutional analysis is complete without a risk assessment. Investors must monitor three primary vectors. First, valuation. Palantir often trades at a premium multiple, leaving little room for execution errors. Second, government lumpiness. Defense contracts can be subject to political cycles. Third, scaling friction. Despite bootcamps, the software still requires significant organizational change from the customer, which can slow the pace of total market penetration. Palantir is increasingly positioned as the operating system for the modern enterprise. Understanding this structural shift is the difference between following the hype and following the capital. For deeper and more research-driven frameworks on technology cycles and institutional market thinking, visit macrotradelab.com. We help private investors navigate the complexity of the global markets. Thank you for watching.